Hello, guys. How are you doing today? Today, I'm going to be talking about Google raising $80 billion. And before I do that, let me just make sure that you can actually hear me. And let me also just pull out. I have a presentation that I created for you guys so that at least I can have a flow of my ideas. So, okay, yeah, this is clear here. So, Alphabet is raising $80 billion, like I just said, and this 80 billion, they are raising it in the equities market, right? And they specifically want to fund the artificial intelligence build out. And in this video, I'm going to be sharing what this means for shareholders. And when I was preparing this, Google was trading at $361.85 yesterday. That's when I was making this presentation. But for those who don't know me, my name is Isaac Jonas. I am an economist by training, and I like to talk about markets, what's going on in the market. So let's get into the nuts and bolts of this. And if you are new here, thank you so much and welcome to my channel. Make sure that you subscribe, you follow me. I did a deep dive article that is on my website, www.streetwiseeconomics, if you want more detailed analysis. And I share this with the view to just share what I'm learning. It is not investment advice. Now, I saw this announcement. I usually watch Bloomberg TV, and that's usually how I get some breaking news and also an X. And I was like, okay, this is very interesting. And so I went on their website and I tried to analyze and see, try to interpret what this means. So here is what I took out of this. Out of the 80 billion that Google is raising in the equities market, remember there's the debt market and equities market. So the equities market, they are coming to shareholders, right, in the public market, right? And now that comes with some challenges, some benefits, and also challenges, which I'm going to explain here. So, for the 80 billion that they plan to raise to fund their AI compute and data centers, 30 billion is going to be underwritten by public offerings split between convertible, preferred, and common stock. Google, they've Class A and Class B shares, and this is something that is interesting. The difference is that the others have, I think, a much more weighting on the voting rights. And then the 40 million that they are raising to make it 70 billion is going to be at the market rate, the program where people can actually buy these shares starting in Q3 this year. And the 10 billion has already been secured through a private placement by Berkshire Hathaway. And those who know, this is the company that was led by Warren Buffett until December last year, still relatively active. Now, why is Alphabet choosing equity over debt? I think the reason, I think this is a smart move because they've already raised about $85 billion in debt this past year. And, these companies, they get some rating, right? So they don't want to ruin their credit rating. So I think going to the equities market, that might be, in my view, a smarter move, but also notwithstanding some other challenges. But for those who don't know, what is the business model behind Google? Alphabet in particular. How do they make money? Because when I'm investing in the stock market, in the public market, I want to know what the business does, and then by extension, understand their business model, valuation, who is leading them, and all these other nuances like their financial statements, etc. Now, Google is well known for Google search and other related, advertising components. So for me, if I want to do Google Scholar or Google search, I used to just go directly to Google. Now I can go to other, options. And that's why I think it is pertinent that Google is actually raising money to fund the AI to actually accelerate their, AI drive. Then there's Google Cloud because apparently actually I have a Google email, but actually now they've been restricting me in terms of I have a lot of emails and documents that are there in my Google Drive. Now I have to pay for storage. So that is another source of revenue. So now imagine big companies and all big institutions, they can actually buy more. And this, if you multiply by a lot of people that actually use this as a facility, you see that on their growth story, if you look at their financial statements, you see that this Google Cloud component actually has recorded 63% year-on-year growth with a backlog, right? So actually, this is a very profitable business. And there's the subscription and devices, right? There are 350 paid subscriptions as of Q1 2026, which was one of their strongest quarters for consumer AI plans. Now, there are other bets, they invest in other ventures like, way more and more. And because they have a very strong balance sheet, oftentimes these they tend to actually bring outsized returns. So it's a very big enterprise. So these are I would say, the four components how Google makes money. Why is this important? I want to invest in a business that makes money and understand why are they raising this money? How is it going to likely pan out? Because Meta, for example, they did that, if you remember, when the Meta stock price actually dropped to almost below 100, I think, from it was high up there, but they'd overinvested in that sector, and investors were just, you know what, we're out of this. I think this is just too much. So Google, in summary, it's a near monopoly advertising machine that has enormous cash on their balance sheet, and now they are actually now redeploying some of this financial muscle and infrastructure to power AI infrastructure so that they can amplify their power sage, cloud, and consumer products. I think this is something that is quite interesting, and I want to explain why I think this is interesting. But before we do that, let's go on the financials. How have how has this company actually performed? Because I like to see a pattern that is interesting, because if I look at their revenue, you can see that their revenue has been increasing. If you look at the trend here, if you look at their net income, it has been increasing. So they have been profitable. If you look at the 12-month trailing 12 months revenue and also the net income, it's also showing that the trend has been a blockbuster story in my view. So their revenue is in the billion, 422.5 billion revenue. If you look at the trailing monthly figure, if you look at the net income, 160.2 billion. How many companies in the world actually just make, this kind of profit, right? Even let alone, even if you look at the whole year, their revenue grew 22% year on year to 110 billion in Q1 2026. So profitability is not a problem here, but funding the build out is something that comes, in my view, with some questions that I would need some more clarity. Now, why did the management go to the equity as opposed to the debt market? Each option comes with advantages and disadvantages, but let's explore that further. I think my honest read, if you look at Alphabet's long-term debt, I'm worried about the long-term debt. If you look at it, for a while, it was actually, much lower than, 15 billion, right? If you look at it, fiscal year 2021, it was 12.8. If you look at this trend, but suddenly for the fiscal year 2025, it has been accelerating to about 46.5 billion. If you look at this data from Stock Analysis and S&P Global. Now, when I constructed this graph, the key thing for me is to look at the pattern. You see, their long-term debt is exploding. now it has jumped, it has doubled, you more than doubled almost now if you include this other coming fundraise from 46.5 to 77.5, right? But let's look at the net cash because they have been borrowing, but they have a very strong, cash, in the bank, which is something that is very smart because if they can get that money cheaply, they can actually reserve this cash for other strategic moves. Now, you look at this, their net cash position has also been declining. It was around almost 120 billion, right, in fiscal year 2021, but it has been declining. This is something that is very concerning for me as an investor. Why? Because once you don't have as much cash on your balance sheet, it means it's very difficult to have the optionality of absorbing unexpected things that can happen in the market. Now, my honest read is that this situation is that the total debt has tripled, right? You can see it's almost now 96 billion, right? And their net position has been shrinking. If they add another $80 billion in debt, that would pressure their balance sheet and credit rating. But well, this capital expenditure, like raise, is interesting because if the return now is actually going to be good, probably. But let's explore this further because I want this to be a story that is backed by the numbers. Now, when I look at this, I can see that in 2026, their capital expenditure is going parabolic, is vertical. It's going very high, like you can see here, right? And their guidance has been in the region of 180 to 190 billion. That's their guidance on the capex, capital expenditure, the money that they anticipate to actually spend. So now this is another source where they are going to get the money to get into this, but it's going to be much higher in 2027. Now, their justification is that there is 460 billion backlog on the cloud business. So the demand is outrunning supply. The demand is there, right? Now they need to provide, right, the service that is needed. So it's like they're investing money when they've already secured the market so that they can meet this demand. So this is very interesting, right? Now, if AI, the demand is booming, you see, there's demand that is exceeding supply. This is, I think, they are one of their reasons why they are going this way. But the issue of going to the public market, equities market, instead of debt or private, the private placement, they got 10 billion from Berkshire Hathaway. But if you look at it, the debt market, they've already borrowed 85 billion that has been raised over, across 6 currencies, and the total debt is now almost 100 billion. It's cheap, but they are getting deeper and deeper into debt, which is a concern for me as an investor to note this trend. At some point, actually, they have to actually address this in a way that makes me comfortable as a retail investor. Now, the equities market, it comes with some share dilution, but I think the key thing in economics is that we look at the trade-off, right? Yes, they are issuing new shares, trying to raise this money, but I think on the other end, when I see institutions like Berkshire Hathaway investing 10 billion, I think it's a vote of thanks in a way. They could be wrong as well, but the dilution is real. The strategic logic, I think, is very sound. Funding compute without breaking the balance sheet, I think it's a noble if they have conviction in this particular situation. But is the price currently fair, and who is steering this? They have a market capitalization of about 4 trillion. Of course, it fluctuates with the price of the stock, but the return on invested capital in the past has been about 28.3%. This is a very good use of capital, right? And their PE ratio, you are looking at, you are paying 20 times in terms of their earnings, right? And then return on equity is about 38.9. This is very good. Their debt relative to their equity is 20%, but I would have loved it to be much lower, but still, compared to most other businesses, this is still something that is good compared to industry standards. And they are led by a very good CEO, in my view, Sundar Pichai, and the team that has actually delivered cloud profitability, disciplined share buyback, and then they have been offering, some dividends, and they have a credible AI roadmap that is Gemini and DeepMind. And I think at the end of the day, it remains to be seen, because it's difficult to predict the future with 100. It's possible to predict the future with 100% confidence. But this is what the AI race is shaping up. Everyone is racing, on the AI space, raising funding. But if you look at SpaceX, they are raising 75 billion. They will be, I think, having their IPO on 10th June, which is probably, I think, which is next week. So this is something that is interesting. So Google actually doing this, raising this, it means they are crowding out, in a way, actually, these potential rivals, right? Because SpaceX, they also have XAI, which is also doing AI stuff. And then OpenAI is going to be listing this year. They want to raise about 122 billion, right? If you look at Anthropic, they want to raise about 65 billion, and Alphabet is already raising 80 billion, and they are already profitable. So the interesting thing is that if I compare Alphabet and other these companies that are going to be listing, OpenAI, SpaceX, and Anthropic, their valuations, they seem to be very high, like at least what has been reported, and some of the information I saw on the S1 form that they filed on the SEC. But the key thing is, I think Alphabet has an edge, because if they are able to raise this and strengthen their AI part of the business, then this might be actually a smart move and a way to actually strengthen their position. So, in summary, my take is that funding is the right thing, compute is the bottleneck for AI, and demand is real. So, investing it makes sense, because they are actually having a foresight. Now, dilution is the cost, because when you go in the public market, you issue more shares, and then you are basically diluting the value. But I think what is interesting is they are using a mix of their financing options, equity and debt, and which is not gonna result in a huge dent on their credit rating, right? Because when public companies go and raise funding in the debt market, they, some investors, they want to look at their credit rating, because you don't want to issue a company that might not be able to pay back the money. So you look at one is that the credit rating as one of the indicators among many to actually consider. So I'm watching their capex discipline, I'm watching their cloud margins, and whether AI revenue keeps pace with the money that they are actually spending here. So the bottom line is I hold a small position, and I actually have an ETF that I constructed, and Google is actually part of that. So I'm going to be investing on Google individually, and also including it in my exchange traded fund that I constructed, I customized. So because I still believe in this business and many others. So this is my take. Thank you for watching. If you want to learn more, make sure you subscribe. You can reach out and let me know what else you want me to talk about. But if you have any questions, feel free to reach out. It's very interesting times, and I'm going to be watching what's going to be happening in the public markets. And until next time, bye bye for now. Take care, and make sure you watch the next episode. Bye bye for now.